Hi, everyone. This is Jason Bierek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He runs an investment podcast over on iTunes called Know Your Risk Radio. He also manages money, pension fund money, and other institutional investor money at Bulwark Capital Management. Zach Abraham, thank you for joining me again.
Hey, thanks for having me on again, man. It's a pleasure to be here.
So, Zach, we're recording this interview on Friday, December 22nd, 2023. The dollar index is down at the trading range at 101.71. We have a nice rally here in gold and silver, especially gold. I think it's up to, let me just pull it up here on my Crash Kitco website, which got hacked about a week ago. We're well over $2,000 at $2,052 on the rally. I want to get your thoughts, though, on this bipolar behavior for risk on, risk off in the stock market. Have you ever seen anything like this before, where so much capital so quickly, capital inflows, capital outflows are happening with money market funds into risk on and risk off before?
No, and it's actually something, I'm not one of those guys that's been doing this for 35 years, but I've been, actively managing a portfolio for, 16, 17? I started running I had the pleasure of starting to run my first portfolio at the end of 2007. So I've been doing this a while, and I've seen some pretty frothy environments. This one's really unique because it's not just the manic risk on, which you point out perfectly. I mean, that's absolutely what's happening. It's the completely, and people are like, oh, where you've been for the last 15 years. And I'm just telling you, as a guy that's been looking at this, up close, trading it, managing it for the last 15 years, things have been frothy for a while. This has not been a cheap market, really, probably since 2012, 2013-ish. And I don't think it was that cheap prior, but I mean, valuations just looked far more subdued at that point. This is fascinating because not only do you have things that are extraordinarily expensive that make zero sense, and this is a big company, and I understand there are reasons why people would buy it still, but I think a great example of that is just right at the top of the S&P, right? You look at Apple, they post a record 4 consecutive quarters of declining revenues, declining profits, declining margins, while interest rates, in the midst of the greatest interest rate hike of all time, the stock's multiples blown out by 50% this year. I've just never seen moves like this. And then you look at the other side of the market, and there is stuff that is that irrationally cheap. So I think long-term, there's the opportunity. But the way that stocks are moving completely disconnected from the underlying fundamentals on both sides, right? Like, so I'm not just saying it's just expensive. It's fascinating because you just look at these moves and you sit there and you go, I can't even come up with a way to the other day I saw a company's stock. I'm trying to think of that. I want to make sure I get the numbers right here. I saw a company's stock rally the equivalent of like $4.5 to $5 billion in a market cap, per day. And it's because they got, who was it? And it was some cyber financing company or whatever. They got some no-name company with $300 million in annual revenue. That was the news that hit the tape that day. And the subsequent stock rallied $4 billion. Which, you're just looking at that and going, look, I've seen overreactions in markets, but this takes the cake. You literally look at these things and it's other than just idiocy and bullishness. You know what I'm saying? It's just hard to, it's becoming almost impossible to tether these things to any kind of financial anchoring. And so, no, I've never seen it. If you would have told me at the beginning of the year that rates were going to go up another 150 basis points and multiples were going to blow out on the S&P 500, I was joking around with some clients and I was sitting there saying, hey guys, if you would have told me exactly what happened economically this year with rates, everything, giving me all the data up front, I never would have bet on the things that went up as much.
Well, would you say that there wasn't really quantitative tightening? So I know the narrative out there is that the Fed's reducing its balance sheet by over $1 trillion, but there was all those shadow liquidity programs. I mean, the banks were tapping BTFP, which is supposedly technically supposed to expire, I think, in March. Wink, wink, nod, nod. I think that's probably going to
Yeah.
get extended. What's the old Milton Friedman quote that there's nothing as permanent as a temporary government program? So I think to save the regional banks, BTFP will be extended. There was other shadow liquidity programs too. I mean, there was the FHLB, which is where the banks post with collateral. I think over $1 trillion, the regional banks were borrowing from FHLB. So there was all that extra shadow liquidity sloshing in while the Fed claimed to reduce its balance sheet.
Oh, no, no. Yeah, there was that. If you want to go look at the financial impacts, you have to make the argument that the Fed didn't reduce anything, that technically the balance sheet went up. And I don't care what the nominal number says. You bring up the BTFP. What about the record increase in Social Security? When you look at the liquidity that's been pumped into the market, it far outweighs any drawdown they had on their balance sheet. So yeah, no, it's an absolute myth. And it's actually been something that I mean, we all know the normal memes and government's never going to stop spending and all this kind of stuff. But it honestly has been a bit of a head scratcher for us all year when you look at what the Fed is trying to do, and then you look behind the scenes and everything Treasury is doing, everything the U.S. government is doing, and everything the Fed is doing is undermining it. And furthermore, I don't look, interest rates have an impact, but one of the impacts of interest rates, one of the reasons that they bring in asset prices, one of the reasons that they tend to combat inflation, not always, but they tend to combat inflation, is because they reduce liquidity. Like that's the whole point. So if you're sitting there going, we're jacking rates on one end and we're piping liquidity even faster on the other end, it's a head scratcher. Now, I think we could make a bunch of jumps off that and conclusions. But, and I don't know the answers to these things, but I don't think you have to be a conspiratorial minded person to look at the whole setup and go, I wonder if the people making these calls realize that they really can't raise rates in a meaningful way. They really can't pull the liquidity away. Because if you do, what happens? You've got an entire world, an entire financial system that's been built on the back of 0% rates for 15 years and unsustainable levels of government spending. You can't just turn that off, right? So, like we've said all along, and I know you've said this too. I think you and I have even talked about it. But there was this obvious hole in Fed logic and Fed policy that you saw for the vast majority of this entire cycle. And in my opinion, the hole was this. When you go this far and you build a balance sheet that much and you pipe that much printed money into a system, at some point ceasing to do that will create as big of a disaster as you were trying to avoid in the first place. Right? So
it's moral hazard. And then look at all the bad behavior from 15 years of artificially cheap interest rates and quantitative easing. I mean, look at how much corporate debt exploded, consumer debt, government debt. I mean, all that debt in all levels of society exploded because the Fed kept interest rates artificially cheap for way too long, for almost 15 years. That's the Austrian school theory of the business cycle playing out. That's the artificial boom. And then when they try to raise rates to quote unquote normal levels, then you start having the bust. But I think there's a lot of panic behind the scenes here in DC. I mean, we were talking about this before we started recording. I think Janet Yellen, when the 10-year U.S. Treasury yield got to 5% over the summer, June and July, I think she panicked.
I think she did. And the cognitive dissonance is really a hell of a drug, right? And I have a kind of an interesting insight into this because growing up, my father and grandfather ran a brokerage firm. So I was raised in the industry, and then my grandfather was the head of the Western states of the John Birch Society. So I grew up in an environment where I remember going through my parents' closet one time and running into this big box of like rolls of nickels and quarters and stuff and going, what is all this for? My dad's like, it was when we were worried about the collapse of the dollar back in the early 80s. But you look at the current conditions, and we currently have those conditions that guys like that were warning about 40 years ago, and nobody cares. It really is. It really is staggering to watch.
Is that because, let me interrupt you. Is that
Yeah.
because you're an asset manager? I don't manage money for a living. You manage pension fund money. Is that because all these asset managers like yourself and other institutional investors and asset managers, everything is so short-term oriented? And if you don't produce results, you don't make money with stocks and bonds at the normal assets, then you're looking at losing your job and losing enormous assets under management. So that's why everything's so short-term?
I think that I think it's that. And then I think it is um, yes. So I think that that's half of it. I also think the half of it is if you look at the quote unquote gray beards in the industry, usually when you go into an industry, it's the old folks, right? It's the old guys. It's the guys with all the gray hair that have experienced all the tough times. Well, go do the math, right? You got a lot of guys now at the head of these financial institutions that have seen nothing but markets go up for the entire 35 or 40-year duration of their career. And that just, I had a back and forth with a guy on Twitter today who's one of those guys, and we won't have to name him. He drives me absolutely nuts because he's got some of the most vapid analysis I've ever heard. But the guy talks about 10 to 15% returns out of the stock market like they're a birthright. He put out a tweet today where he's saying, I can't believe people think there's going to be another bear market. They ignore financial history. You never have 4 bear markets this close together. And he cited 2018, 2020, and 2022. And my response to him was, tell me you've never traded a bear market without telling me you've never traded a bear market, right? A bear market.
Also, interest rates went down since Paul Volcker, right? There was 40 years of interest rates going down.
That's right. That's right. Yeah. So you've got conditions that nobody has traded, including me, right? But what do we know about our society? And I think this is true on all levels. And I'm not a sociologist, so I'm not really qualified to say what this is. But I don't think it is hyperbolic or unfair to say that for whatever reason, culturally, whatever it is, that we have become increasingly historically illiterate as time has gone by. And so everybody acts, for instance, you look back at the 70s. What I find really interesting is everybody's all bulled up at the start of a new bull market, right? You know what I'm seeing? I'm seeing a market that's been range bound for 2 years. You know what that's reminiscent of? It's reminiscent of the last serious bout of inflation. And so everybody, it's there, and there's another odd dynamic that's happening. And again, Jason, you might be able to answer this because better than I can, because again, I'm not a sociologist and I haven't really dug deep into this stuff. But what I have seen increasingly over the years is market participants anchoring to the least likely outcome, right? So if we listen now to debates, it's like, well, are you in the soft landing camp? Are you in the hard landing camp? It's like it's a debate, right? But you look at the underlying realities and you're sitting there going, okay, you guys act like this is a 50-50 toss up. Your base case is something that's never happened before, which is all of the conditions that are present have 100% of the time resulted in a recession, right? All of the conditions that are present, the outcome has always been the same. The one thing the Fed has never been able to do, except for one time in 95, and the conditions were completely different, and the constraints were completely different. The Fed has never engineered a soft landing. So it's just this, I'm not saying, I don't think it's going to happen, but I'm not saying it's not possible. What I'm saying is any sober-minded person that has been in this industry for any period of time and is cognizant of financial history, they wouldn't bet that a soft landing is the odds-on favorite. You know what I'm saying? It's just like,
but that's a real economy. So we have to make. I think this is important with the Cantillon effect and what the governments and central banks can do policy-wise, monetary and fiscal policy with government spending or central bank balance sheet expansion or rate cuts or whatever the Fed decides, whatever shadow liquidity or bailout program the Fed decides to do. We have to make a distinction, like you said, between the real economy, potential recession, and asset prices. Because I don't think they'll let asset prices stay low for long without more rules changes, goalpost moving, intervention. It just seems that really since 2008, they don't want to let asset prices stay low for very long anymore.
Jason, I don't know that they can, right? Like, meaning when you look at the setup of these markets, when you look at the setup of our culture, when you look at the demographics, everybody talks about consumer spending right now, right? There is one group of consumers that is holding the tent up right now. Okay. That's the baby boomers. They take a durable 30 to 40% hit on their assets. Turn off the lights, man. It's over. I mean, the under 40 crowd is getting smashed, right? You look at higher stock price. People are talking about little thought experiment here. If the market wouldn't have rebounded this year, do you think holiday and retail spending would be different?
Well, I'm not sure what the market rebounded. So we've had this rally with the small caps in the last couple of weeks or so. But I mean, if you subtract the Magnificent Seven from the S&P 500, it's basically flat.
Right. But what does everybody own, especially retail baby boomers? They own all the Mag 7s.
And index funds.
Index funds and Mag 7s, man. That's the whole game. So, it is a mess. And like I said, I think you've crossed a point. Hey, rather than extrapolating or guessing or anything like that, let me just state it really simple, right? You've had no developed economy that has ever crossed the 100% debt to GDP marker that's ever come back. What are we at now? 140 in the US? Is it 140?
I'm sure they'll change how they measure GDP soon.
Yeah, right.
It's time. No, PhD economists that are going to be trolling in the comment section and then giving me phone calls and emails from random numbers. It's time to change the GDP numbers, the formula again. Make some adjustments.
Yeah, no, and it's really fun. You just watch, the whole, another point to us being, financially and historically illiterate. And I know you've heard this too. And I think that this is one of the reasons for all of the confusion out there is that nobody has battled an inflationary market, right? When people are out there touting, we had 8.5% nominal growth, and you're looking at, and inflation's coming down, and you're like, guys, inflation by definition is a rate of change, okay? You don't need a reduction. You do not need a slowdown in the increase of inflation. Consumers can't pay the prices now. Right? You don't need a slowdown in inflation. You actually need deflation. That just gets really hard in an economy that is, sucking on this much debt. So it just, and the inflation, like I said, the inflation argument is a perfect example of what we were talking about people being historically illiterate. And I know this comes as no surprise to you. And I'm sure you've probably got as many, if not more stories than I do. But listening to quote unquote professionals talk about inflation is hilarious. What you realize is nobody really understands it, right? They don't get it. And I really don't think it's that complicated. But it's just fascinating.
I'm hearing tons of people on business television say that the Fed has defeated inflation, it's headed below 2%. And I was like, well, I'm looking at my grocery store bills, restaurant, Walmart, Target, the normal consumer shop. I'm seeing tons of stagflation and shrinkflation still on a lot of items.
Dude, you got houses selling at a lower volume than they were in 0809. Okay. Now, the popular meme out there is, well, it's the reason there's not enough houses selling is, there's a shortage of supply. So I don't know if you've looked into these numbers. Okay. And this isn't my opinion. I'm not going to take credit for it. Chase Taylor, my head of research, did the majority of the work on it. But we actually look back at historical housing data. Do you realize that historically, when you compare it to our population growth, you normalize everything, right? And you're really, historically speaking, we're slightly overbuilt. We're actually really close to neutral, but we're slightly overbuilt. And everybody goes, we haven't built enough houses. And I go, guys, there wasn't a building shortage the last 10 years. It was called digesting the overbuild from the 2000s, right? Of course, we didn't build as many houses because we had a record glut in 08, 09, right? That's one of the things that caused the housing collapse. So it's just, we live in this environment. I feel like it's like this social media dynamic has spread to other parts of the environment where everybody's like, well, I disagree. And I go, I'm not stating an opinion. This is a fact. And you can all repeat that there's a housing shortage all you want. And this goes to my point about inflation, right? Yeah. Clapping their hands, high-fiving each other. Inflation's defeated, right? Meanwhile, nobody under the age of 40 can still buy a house. Right? So what you're really looking at here is, at least near term, I mean, look, I think their plan, and I've probably always been that way, is to inflate their way out of it. But, you're looking at a situation right now where the consumer situation and the quote unquote inflation issue especially as it relates to housing, it's not going to be fixed without deflation. Right? Now, I know deflation is painful and all these things, but the bottom line is the prices of this stuff are just way too high. And there's several different, this goes right around to what you were saying. Why are the prices so high? Well, let's go right back to Fed policy. Well, why do BlackRock and all these institutions own city blocks worth of housing? It's because bonds weren't paying anything for 15 years, right? And that's a whole nother topic. And I'm very much
there was other programs too the Fed implemented from 2008 to like 2012, 2013. I mean, like they were intentionally trying to give hedge funds and institutional investors like all these entire rows of houses at artificially cheap prices, mortgage-backed securities too, because they wanted real estate prices back up. This goes to why governments and central banks hate deflation. They hate the free market because they can't tax it. So if real estate prices are following the deflation, which would be good for people my age and younger, right? So yeah, if there's deflation, home prices fall, my generation can go buy a house that's cheaper, but then the baby boomers are stuck holding the bag. And the governments don't have the property tax receipts and the capital gains taxes from home sales anymore.
No, it's true. And I think that I think, this kind of gets back to my point of saying people are like, we got to cut government spending. You look at them and go, you can't. Like, you still should. But what I'm saying is nobody in DC is going to pick a course of action that the results in that course of action are the same results that all their other course of action were looking to avoid. Right. So meaning, why did we start printing? Why are we spending so much money? It's all about, papering over problems. They're not all of a sudden going to get religion and do something, quote unquote, responsible, even if it's the right thing to do, if it creates the environment that they were seeking to avoid in the first place. And I think the other valuable thing, if there's any younger folks in your audience or people that are learning finance, one of the most tragic things about what you're seeing right now is that you're seeing people increasingly blame capitalism. And when this thing falls apart, I think you'll hear the cries against capitalism even more so than you hear them now. And what people need, I think the big lesson here to look back at is markets were not ever designed or intended to be policy tools. The reason markets work, right, is because the reason markets price things correctly is because they can go down 70%. Now, what do I mean by that? What I mean by that is, in order to price something correctly, there've got to be consequences on either side of that pricing, right? If you get it too high, there's a price to pay. If you get it too low, there's a price to pay. The minute you start interfering in a goal-seeking way with markets, which is what ZIRP is, which is what quantitative easing is, which is what all these things are. And I know I'm preaching to the choir. I know you know all this.
But I agree with everything you said. I mean, capitalism, free market capitalism, you can't have it without deflation and bankruptcy. But it really, since 2008, it seems they don't want that.
No. Yeah. People, because they've got, they found their new shiny look, you could see the shadows of this as early as when Greenspan took over for Volcker, right? The maestro. And now, to Greenspan's credit, I hate saying that because he really was the genesis of a lot. Well, it would have happened with or without him, but he certainly sped up the process. This guy actually believed, he doesn't anymore, but he believed that via monetary policy, you could eliminate recessions, right? And you look at him, you kind of, it's just so strange to me, right? That you have this system and this market and this setup that has created the greatest wealth, the greatest superpower in the history of mankind. And all of a sudden, somebody's bright idea economically is to usurp those rules and to make it work differently. And we don't want recessions where you go, guys, recessions are, everything in life is cyclical. Like, you need it. You've got to burn down the old to bring in the new, right? And they just don't want it. And this goes to your point about, who's in power. Of course they don't want it because it's not beneficial to them and their buddies right now, right? So what are they doing?
If the tax receipts collapse so much, then one of the real reasons for quantitative easing, then the Federal Reserve has to fill the holes, buy all those government bonds, buy the municipal bonds for state and local governments, buy the extra amounts of U.S. Treasuries to finance big government?
No, look, I don't, that's happening regardless. Okay. One of the things that we've talked about a lot is that we've really dug into this. And I think this is actually a pretty conservative estimate. You start looking at all the numbers, and I think it's really, really hard to envision a scenario where 10 years from now, the Fed balance sheet is not in excess of 30 to 40 trillion. You start looking at the math, you start looking at the numbers. I don't see how that won't be the case.
Do you think they're going to be honest about that, honest and transparent? Because right now, I think their policy, I call it no audit, no problem.
Yeah. Well, I mean, the purchasing of debt is a little bit different because, maybe they will try to obscure it, but we know how much debt is being issued, right? And then you can kind of look around. I mean, I guess sovereign balance sheets could hold it, but nobody's going to be loading up on treasuries. But here's the other side of it. When you look at swap lines, it's entirely possible that the Fed could be funding the purchase of treasuries via other central banks. And people look at you and they go, they'd never do that. You go, where have you been for the last 10 years? What I have seen is the Federal Reserve prepared to do anything regardless of the rules, regardless of their charter. So I don't, and the troubling part about it is that you have this culture now, which is stocks up good, stocks down bad. So regardless of what rules they're trampling, nobody poo-poos it, right? Everybody just claps.
Well, the lawyers here, so the average person doesn't know that how many lawyers there are here in Congress, their aides, lobbyists, DC metro area. There's tons of lawyers. So the first thing the lawyers want to do, if they see a problem, they normally want to look at the law, change the law, find a loophole.
Right.
So they're going to figure out how to change the law to their benefit. So they're technically not doing anything illegal, or they can dance around in the gray area.
No, they're doing it for us, man. They're doing it for the folks, right? That's who they really care about, right? All of this is just for the folks. No, but to my point, though, I think there is such a learning opportunity, and of course, it probably won't be taken that way, just because things don't ever seem to work the way they should. But I think there's a great learning opportunity for people here to sit there and go, why were guys like you and I critical in 08, 09 with the response? It wasn't because we wanted things to burn. It's because when you start putting your finger on the scale, you will never be able to take it off. We said for years, the Fed is going to paint themselves into a corner where they need to hike, but they can't. That's what's happened this year, right? It literally has played out. People go, what do you mean they hiked? They hiked, but they were pumping, to your point, they were pumping liquidity in the other side, effectively undoing it. So, I am shocked by the lack of people, just in numbers, that see what's going on for what it is. Meaning, you are seeing a system that, in my opinion, cannot function in a normal, healthy way without constant intervention. And when you just sit back and you look at it, it makes sense, right? Like you have had effectively a negative cost of capital for 15 years. How does that not create distortions, right? Like because just getting back to a normal cost of capital is like levying a massive tax against the economy. So like I said earlier, you've created a reality where the return to normal is the crisis, right? It is the crisis. And they can't take their finger off the scale. You guys like you and I were saying this, the Fed can't really raise rates. And then they've done what they've done, and everybody looked at, oh yeah, all those bears were proven wrong. And you go, and the banking system almost collapsed, and we had to inject another 350 billion. Right? It was like we all knew, but there for that those 12 months in 2022, everybody's like, yes, see, no problem. We're like, hold on, wait for it. There it goes. Right.
Well, and the banks are basically pulling the same tricks of 2005, 2006, 2007 with the legal definitions being changed of what a default is. They're not mark-to-market losses on office buildings or multifamily. So this cycle, it's not residential real estate. And you highlighted some of the problems with residential real estate. There are problems there. Now, I think the way larger problems are in commercial real estate here in the United States all over. It's every major city and metro area. It's all over the place. Literally thousands of office buildings, the banks, the pension funds, the insurance companies, they're holding these office spaces at losses. I mean, I just saw one today. I'm here right outside DC metro area in Loudoun County, the largest shopping mall here. I think it was appraised at $300 million. The insurance company that bought it just panic sold it, I think, for $46 million. So that's 85% write down they sold on that asset on the largest shopping mall in the one of the wealthiest average median family income counties in the United States, fastest growing, Loudoun County here in Northern Virginia.
Funny story about that. So about a year ago, I think I can't remember where, I was on an interview or maybe it was during an interview I had with somebody else, but I said something to the effect of, we're expecting to see, especially in commercial office space specifically, we're expecting to see 60 to 70% write downs. And I got blasted, called an Uber bear. And I just, so now the problem has become more acute. And the guy that blasted me came back and was like, wow, I guess I was a little too bullish. He's like, he was like impressed. And he's like, how did you know that? And I go, we factored in a 30% lower demand and we ran the loans at 6%. Right? Like it wasn't some Michael Burry deep diving reading through the mortgages. It was just back of the envelope arithmetic. And you're like, hey guys, commercial. And I think here's the other problem with commercial real estate in particular. I don't think most people realize how it works, right? It's not like residential real estate. It is valued solely on the income it can generate. Right. So right now there are buildings, and I've looked at some. There are buildings out there that probably cost, I don't know. I'm just sitting here in my local area because I'm keeping my eyes on them because I'm planning on buying an office building for us. Rent out other parts of it. So I'm keeping my eye on the market. And there are office buildings that cost $20, $25, $30 million to build that you can buy for $4 million, $5 million. Why? Because it's not valued right on property and building the way that people would think it is. It's just valued purely on cash flow. And the work at home has probably knocked that number, let's say, down to 20 to 30%. And everybody's like, oh, work at home is going away. And I go, no, it's not. No, it's not. Especially while inflation is alive. Why? Because let's say you're a 32-year-old guy that gets hired by a tech company. Okay. And they want you to move to San Francisco. And you're like, they're like, well, we're going to pay you $200,000 a year. And the guy's looking at him and goes, you know what? I just bought a 4,500 square foot spread in the suburbs of Detroit for $450,000. Right. I'm on an acre and a half. We got I got a pool in the backyard. Why don't you pay me $130,000 and let me work here? Do you know what I'm saying? So people are like, why don't you think that this is going to go away? And I go, guys, because people are human beings. Whenever you see a scenario where both sides of the transaction benefit, that's what they're going to do. Right. So,
well, you're also seeing it as part of negotiating higher salaries with the inflation offsetting. You're also seeing a lot of unionized workers. They want a couple days a week negotiated in where they work from home. So that's kind of the new normal now, where there's at least 1 or 2 days a week minimum now where people work from home. So that's like part of the new normal, I'd say, that probably wasn't as apparent before the pandemic.
Yeah. So even if the Fed brings down rates, you're just not going to. And like I said, I think the easiest way for those scoring at home, the easiest way to track what's going on in commercial real estate is just all you got to do is look at cash flows. Right. That's it. Just look at the cash flows. And that's why even if the Fed aggressively cuts, I think you're still going to see a ton of foreclosures. You're just going to see, and you're going to see exactly what we've been seeing, which is you're not going to hear about it a lot in the press. Well, because they're all part of the.
Well, the banks are their advertisers too. So if the banks are in trouble, their banks are going to phone into the producers of these shows at CNBC. Why do you think the Zero Hedge was started as a blog? A Zero Hedge, like I know some of the original writers of Zero Hedge, they're all disgruntled assistant producers at CNBC that had their stories about the banks and the housing bubble killed. That's how it started as a blog.
Interesting. I didn't know that. I didn't know.
Yeah, they were all leaking it anonymously. Yeah, I'm friends.
That's crazy. I didn't know that origin story for them. But no, that makes perfect sense. And like I said, the commercial real estate, look, there are going to be places where some commercial real estate is going to be fine. There are going to be places where it gets hit. pretty much everywhere commercial office space is going to be pinched. It just is. And it's just math. How much does it need to go down? All depends on where rates are. But bottom line is it needs to go down. It just does. And this trend at working from home is only going to grow for the reasons that I just stated. So,
well, on top of working from home, Zach, you also have people that are doing online shopping. So if you're a retailer, you can set up a warehouse. You can sell from your website. You don't need all that fancy space in malls and strip malls and fancy malls. You don't need as much real commercial space for retail anymore. So they're downsizing there too.
100%, man. And that it's why it's one of those unforeseen consequence things. If you really want to sit back, and I honestly didn't think that I'd say this, but if you really want to sit back and analyze the situation just through completely non-jaundiced, now I don't think this is going to happen. They're not going to let it happen. It's not that I don't think it will. It won't, because they're not going to let it. But what you see is all of this stuff, all of this crazy spending, what it's created is and I don't think anybody's saying this. I don't think anybody's realizing this. What you're up against is a massive deflationary wave, right? Which is weird because I think inflation is here to stay, but I think it's going to be here to stay because it's like a government policy, right? Like there's two ways governments resolve the issue that we're currently in, right? A, they let it burn and let it clean itself out, or B, they inflate it away. I don't think we have any modern examples of them letting it burn and cleaning themselves out, right?
It's normally an emerging market that does that can't borrow anymore.
Right, exactly. And so we're in a third world emerging market position with the most powerful printing press of all time. And like I've said from the very beginning, and I'm not the only one, you've said it too. Look, the easiest prediction to make for the future is that everybody that can will push the print button until it breaks. Period. Like that's just gonna be the way it works. And yeah, man, it's really weird. It's really weird to finally be here because these were conversations like you and I were having in 2015, 2016, on the road to perdition, if you will, saying, hey, this is where it's going to end up. Had you told me by 2023 we were here, I would have said, that's a bit aggressive, right? In 2015, 2016.
Well, look how much was printed, though, in 2019 during the repo crisis. I mean, they printed many, just the U.S. alone, it was at least, I think, 6 trillion in currency supply just in the U.S. And now globally, it was even more than that. And then the economy wasn't producing goods or services. So that was a lot of stagflation from all these governments from 2020 just to 2022.
No. And so I think that this, look, don't get me wrong. I'm not excited, but there's a part of you that when you do this for a living, right? Like just like you are, right? Like I'm a student of markets. I'm passionate about it. And there's a big part of me that's just really curious to see how 2024 rolls out. And one of the biggest things of interest to me is, do we avoid a recession? And if these were quote unquote normal times, I'd be laughing at anybody asking that question, right? I'd just be like, do we avoid a recession? Are you kidding me? The question is how deep and how long. This thing's coming, right? On the flip side of that argument, when you're running $2.1 trillion deficits and you know that any weakness is going to be met with greater levels of spending, right? And then you look at, I don't know if you've looked at corporate CapEx, right? It is soaring high too. When you're looking at those, and it's soaring high because of a very few actors, right? This is not obviously an economic. It's mostly chip and manufacturing, buildings that are being put into place, and then spending on AI. So but when you look at that much being pumped into an economy, despite all of now I personally believe the odds-on favorite are as a recession is going to materialize regardless. But it's a fascinating setup because, again, people go, well, that doesn't matter. And I'm like, well, you said something earlier that I thought was just dead spot on, which was they'll just rejigger the way that they look at GDP. I don't think most people realize that GDP effectively, now this is oversimplification, obviously, but GDP effectively is just a tabulation of transactions, right? So if your currency is being devalued, and if they're telling you it's not, but increased government, right, increased spending, and the transactions are going up, even if it's for the wrong reason. Oh, the economy grew by 5. No, the economy didn't grow at all. The cost of everything went up, right?
Well, they also count government spending. So all the transfer payments, all the government bureaucrats spending their budgets, that's all counted positively as GDP.
Right.
Murray Rothbard, Austrian school economist, he said that government spending should be subtracted from GDP.
Yeah, no, it should certainly have some type of decelerator put on it, because we all know that, you know what I mean? Like in economics, you got accelerators and things like that, meaning that, if you see certain types of spending, you're like, hey, that's really effective spending, because that's spending that just keeps happening, right? Government spending is the opposite. It's the most least efficient, most price insensitive spending. And so it tends to be the most productive or the least productive. So a perfect example of that, you probably remember this name. I think a perfect example of this dynamic. What was the name of, it's not Solana. That was the name
Solyndra,
of the
Fisker,
Solyndra, right? Government loans them $500 million, and what wasn't it, like 8 months later they were bankrupt or something like that?
Well, you have the electric bus company that was a pump and dump scam with the current Department of Energy secretary. Oh, Nikola. Oh, that guy's going to prison for fraud. But almost all the other electric vehicle companies other than Tesla are looking at bankruptcy, I think, soon.
Oh yeah. And what'll be interesting to see is if the government allows that, right? I can just hear it. Well, look, we've got they provide this many jobs, and it's a clean, this gets me back to a lot of the stuff you talk about, which is, unfortunately, as this situation devolves, the opportunity and the ability for fraud increases with it, right? Because it's easier. Well, why? What do you mean you want to give them $1 billion? Well, they provide 400 jobs in my district, and they're trying to save the planet. Look at all the polar bears that are going to be, you know what I mean? Like, there's too many BS levers they can pull, too many heartstrings they can pull to make people look the other way. And at the end of the day, look at all the positive economic commentary you get out there. You and I both know that this is all about, like, everybody's, oh, well, look at the pop you've had in consumer sentiment. And I'm like, guys, you just had the best month for asset prices in history. It's not about the economy doing better. It's about the stock market going up, right? So I don't know, man. When I get involved in these conversations, it really blows me away, because I can't. I mean, I can. I've seen the whole thing happen. I understand what's happened, but I can't believe we're here. And I cannot believe the level of disregard and the lack of care so many people have about it, where you're like, hey, guys, I'm not saying that the world's going to end tomorrow. I'm not. What I'm saying, though, is the final act has started, meaning you are going down this slippery road, and you either have extraordinarily hard economic times around you, or headed your way, which I think is going to happen regardless. Or you're looking at just massive inflation.
Well, also not just the currency debasement. I think also what's happening, that DC is wasting, and I call it the energy spending grift, with the ESG policies on wind, solar, biofuels, electric vehicles, all this other stuff. The return on investment is negative, because if you're doing a bailout or the company's going bankrupt or needs to be saved, then the return on investment is negative. It didn't produce anything positive for the actual economy. I think we're looking at just a lack of investment still on the supply side, despite DC spending like crazy on all these key commodities, especially non-ESG energy, whether that's like nuclear power, coal, natural gas, liquefied natural gas, oil. There's just been, even though we had high oil prices for 12 months, there just was not a lot of investment on the supply side.
No, well, look, this is one of the dynamics that we talk about on a regular basis, both on our show and other interviews we do. But there's a really, it's human behavior, but there's a really simple, I think, explanation for a lot of this. I was having a conversation recently where they were like, Zach, why are things so detached from prices? And I think that there's a lot of reasons, but at the end of the day, I think it comes down to this. If you have sectors that, of companies that have their that are tied at the hip to the federal government, that have inflows of government capital, that are big enough to influence government officials and things like that. And if you have the Federal Reserve pumping cash into the system all the time and everything just keeps going up, price discovery becomes something that isn't needed, right? Like what you should actually be looking for are the vehicles that are the most likely, not conduits, but the most likely overflow buckets for government largesse, right? And deficit spending and all that kind of stuff. And when you get in this
Tesla Motors.
Yeah, right. Yeah, I recently called Tesla a dream machine, right? Like meaning it's the perfect right? It's the perfect apparatus to hang any level of dream or anything. Like I called it a financial coat hanger, meaning you could put anything on it and dress it up however you wanted. Some people it's about autonomous driving. Some people it's about they're going to take over the entire auto industry. Some people it's about taxi, the biggest taxi service. It's whatever you want it to be. And when you get into an environment like that, where every panic is met with printed money or again, another source of fake stimulus, it's going to continually embolden investors. And then after a while, if you were looking at that environment, you'd sit there and say, and I think it's a somewhat logical, I mean, it's dangerous, it's going to end in tears, but I think it's a somewhat logical conclusion of why am I going out there to buy discounted cash flows when I can go buy dream machines that go up 4 to 5x a year, right? Meaning one of the reasons that we do financial analysis, one of the reasons that you and I approach this work the way we do is to help ensure or to help engender a greater level of being right, a greater level of success. But when you're in an environment like this, right, isn't the easiest thing just to roll with the tide and play the five? You know what I'm saying? So you saw a similar dynamic play out in '99, and I think this gets into something that you and I were talking about, currencies too. I think people forget that all financial assets are relative. Right? They're all relative. When you're watching people make 2, 3, 4, 5, 6x their money in large cap stocks, right? We're not talking about speculative junior miners here. We're talking about large cap stocks. You make
like
4
Google,
5,
Apple, Facebook. Yeah, they're up enormously. I think Apple had a 50%, and Meta or Facebook had they were up 60 or 70%. So big numbers.
Yeah, well, I mean, at least for Meta, it was coming off of 8 times revenue or 8 times earnings, right? Like, so I actually thought we've actually played the Meta rally, not in size. It wasn't a big position, but because, the simple base of the premise was, look, if Zuckerberg continues to do this, he's going to ruin his company. Like Zuckerberg's not dumb, right? He's going to realize he's too aggressive. He's going to turn the profit back on. He's going to slow down metaverse. And sure, that's what's happened. Apple to me is even more incredible. It's a mega cap company that came into the year. Now, Cook has even gone on, to Tim Cook's credit, he has even said that Apple is effectively an ex-growth company, right? It's $3 trillion in size. The law of large numbers is undefeated. Okay, so he's stating the obvious, but at least he said it. They came into the year trading at 20 times revenue. Right? It's not cheap.
And they did share buybacks with debt. And then Xi Jinping just banned iPhones from Chinese government officials.
Yeah, and this year, on the back of a record 4 consecutive losing quarters on all metrics, right? It wasn't like they missed earnings because iPhone sales went great and they had a snafu with iPads and it's a temporary hole, right? There none of that. Literally a deceleration in their business while the discount rate went up another 150 basis points and their multiple expanded by 50%.
Didn't they do a ton of share buybacks with debt though? So they did a ton of share buybacks with debt.
No, I know they did, but you and I both know. Well, are they still doing them?
I haven't looked at the numbers recently, but I know that's been a trend, and I thought they increased it. They were able to borrow a substantial amount of debt, I think, at lower cost of capital, compared to what the interest rates were. I know they were loaning. I think Apple was investing some of their cash in U.S. Treasuries, so they were earning like high interest on some of their cash, and then I think they were loaning out to. They were doing some consumer loans too, I think, on some stuff.
Hey, think about how crazy that is, dude. Now,
Well,
maybe they haven't this year. Like we've got to go look at, but let's just for the sake of argument, because I know several other companies are, right. Like I know several. For instance, I was reading. This is just the most recent one. I was reading a Q from Sonos, the speaker company, the other day. They're not having a good time. They just sat aside $200 million to buy back their stock, and it's not crazy expensive, but it's not cheap either. And I'm looking at them going, okay, that might rally your stock, but you can make 5% risk free. What in the hell are you doing buying back equity at these prices? This is nuts.
What was their valuation? It depends on their valuation. So if you're like a gold mining company and you're at like 2 times cash flows and the market is mispricing you where it's valuing your company at like 1,500 gold and your free cash flow is enormous at current metals prices, it would make sense on valuation to maybe buy back your shares at 2 times cash flows with your profit margins and free cash flow. So it just depends on valuation.
Oh, 100%, but that's a pretty easy calculation to do, right? If I'm generating a 25% internal rate of return, an IRR, right? Yeah, then buy back the stock. Why would the 5%, but you go to Apple, you're talking about what is the earnings yield on Apple is like 2.7%. You're buying back equity in that environment when you get a 5% risk free. Why don't you just park the money in 2-year treasuries, let it grow, and then take that money once your stock gets cheap, because stocks do go down, contrary to popular belief. But let the interest earned help you buy an extra 10 to 15%. It's just, and I don't understand why officers are making these decisions. That's the part to me that is really perplexing.
Zach, the insiders at Apple and those tech companies, they have to cash out their stock with their stock options. So they have to do they have to do the share buybacks to soak up the new shares that are created.
That's true. And Mike, no, that's a really good point. And Mike Green made a really good argument, in my opinion, the other day that I hadn't really thought of. And he goes, we have this assumption that as a stock gets bigger, that the tradable float, like every single day, right? The amount that gets traded grows with it subsequently too. And that's not the case, right? Usually, you have to smooth it out because it can spike and it can drop. But usually, now, if a company goes from a $500 million market cap to a $50 billion market cap, of course, a far greater number in terms of dollars of their stock is going to be trading every day. But his point was effectively, just because the stock goes up doesn't mean significantly more money is transacting in that stock. And I hadn't really thought about it in that way before. And what it really creates is that in an environment like that, especially when you're adding to stock buybacks on there, right, decreasing the amount of paper on the street, you by definition are eventually creating more brittle asset prices. Meaning, you know what I mean? Like, because
it's also the way compensation is done in Silicon Valley too, especially with the larger and medium-sized tech companies, that there's a ton of accounting fraud. They don't expense the stock options. So like you see with Facebook and Google and Apple, like when the executives are getting paid so much in stock options, that's a lot of extra share count. So the share buybacks are not done. They're not done measuring valuation. They're done to soak up the stock options.
Here's another one, and that brings up another interesting point. And look, don't you laugh, please, and don't anybody listening laugh when I ask this question. But I think it's a question that needs to be answered and needs to be thought about, which is, where are regulators in all of this, right? Meaning, another interesting one, Jason, is that when you look at earnings per share, right? Stated earnings per share, and then taxable earnings per share, the gap between those numbers is a record, right? Like, and it's not a record because it's 2% higher. I mean, that that relationship has blown out. Okay, so what does that tell you? It tells you that a lot of the earnings that these companies reporting are nonsense, like you just said, accounting fraud. The crazy thing about it is it's not fraud, right? Like what was WeWork's? What was their metric? It was
they created their own. I mean, they were
wasn't it like community adjusted earnings or something? It had some.
It wasn't even adjusted EBITDA. It was not even that. I mean, like some of these companies you see in their investors presentations or quarterly filings, the phrase adjusted EBITDA like over 100 times, which is a red flag. But it was even worse than that with WeWork. They created their own metrics.
Yeah. Well, and I think a lot of people. I look. I don't think they're the only one. And like, I think a lot of companies are doing that. And I can't tell you how many times. Well,
why should Nancy Pelosi care when she's making $5 million or $10 million on the inside information from her congressional, from her Senate committee and subcommittee with her top secret security clearance, and she's making millions of dollars extra on her stock options trading?
Yeah, no. Look, it shouldn't be, but no, and that's right. All of these things are consistent; they all fit. But just looking at the regulatory, for instance, let me bring up another one, Carvana. Okay, I was reading through their most recent Q, and they claim. Now we all know what car dealerships are getting brutalized right now. Okay, they're just getting brutalized. Used car dealerships the worst. Okay.
Electric vehicles too. Apparently they don't want. Apparently they don't want the car dealers don't want the electric vehicles. They're trying to send them back.
Yeah. Did you read the recent Q by Carvana? Have you seen it?
No. Please tell the listeners. Is it really comical?
2.7 billion of revenue and 780 million of net profit. They are stating that their net revenue for the last quarter, that their net margins in their business are 28.5%. You want to impress me if you're out there. Look, if you're out there and you're a CPA and you want to get hired as a credit analyst or heck, even the CFO of my company, I will hire you right now if you can show me math that makes that work. Hey, they sell used cars. Okay. The only way you get to that number is if they are buying cars at a 20 to 35% discount to market and selling them at a 10 to 15% premium above market, and then loading them up with the extended warranty. And even then, I don't think the numbers make sense. In this environment, they put out that earnings release, the stock shot up, and you're looking at that and going, you got why? Well, their internet. They sell used cars, right? Like,
so basically they fooled the algorithms. They fooled the trading algorithms that we beat on top line, bottom line margins. We had a beat, and they fooled the trading algorithms, and that caused a short covering rally.
Yeah, but I mean, it's been going up all year long. And meaning you look at this company, and this is where I'm talking about, it's somewhat typical bubble behavior. What is not typical is watching the bubble pop and then reinflate, right? So they were down to $3 and change at one point this year. And I remember looking at the stock and going, you know what, you should throw 50 bips on it because these idiots are going to come back and bid this thing up. I didn't, should have. But I just think about that. In this environment, and they go, well, it's tech. No, tech is how they advertise. Okay, at the end of the day, they sell used cars. Okay, so what does that mean? That means that they have to sell them. They are subject to all of the same costs that all them being tech-based does. If you look at their business, all it does is allow them, it cheapens their marketing, right? That's all it does. It doesn't improve their margin. They still have to floor the cars, which means pay insurance costs on it. They still have to pay to move them around place to place so they can get the cars to the people. They still have to buy the cars from somebody. And so and everybody go, well, it's tech. And you're like, good God, people. It
wasn't real tech. Yeah, it was just marketed as tech. WeWork was marketed as tech too. It was just they were charging higher square. They were dividing up the office space for startups into smaller amounts and charging a higher square footage percentage.
Look, WeWork did what literally hundreds of companies have tried to do over the last 100 years, right? They bought, right? They financed long and they rented short, and it's never worked. It's never worked. There's no revolutionary tech in that. They bought and borrowed long-term. and they rent it out short term.
Well, didn't they try to split up the space into smaller amounts, but the square footage percentage they were charging the startups was actually way too high compared. But these were startups that were raising Silicon Valley unicorn investor funds, right? So it was other people's money. It was never the people that were starting the startups' own money. It was only like pension fund money, SoftBank money, angel investor, venture capital money. So as long as there were cheap rates and the company could grow revenues, right? So it was a Silicon Valley unicorn treadmill of raising equity capital, higher valuations. They could keep paying their rents at higher square footage at WeWork. Well, when the startups couldn't raise any more capital, that stopped too.
Yeah, 100%. And that's the other thing. You sit there and talk about a recession or markets or anything. We've gone through this whole discussion and we haven't even talked about private equity. And I will just tell you firsthand, knowing guys, I've got very good personal friends that are partners, senior partners at fairly sizable private equity firms, multi-billions of dollars. And these aren't just anecdotal stories off of CNBC. These are conversations I've had inside of boardrooms with friends of mine, all that kind of stuff. There is so much trash in private equity markets. There's some great companies too, right? It's always a mix, but there is so much trash in private equity markets. And the two biggest reasons for it, let's go back to narrative. Right? Remember, what was the battle cry of private equity over the last 15 years, right? It was equity returns with fixed income volatility. Okay, that doesn't exist, right? The only reason you get equity returns is because you are willing to accept equity volatility. The two cannot be separated, right? So what happened though was I've heard this from multiple contacts and friends in the space, that as these companies, and this is as early as 2016, 2017, this has started happening, but liquidity has really dried up and they're dropping like flies. But one of the things that they did was they would invest, the VC funds would invest, and maybe they'd do a debt round, maybe it was an equity round or whatever. But even in the debt rounds, specifically in the debt rounds, they'd come back to the guys and they'd be like, all right, well, hey, you guys are run thin on cash. You got to figure this out. And the startup would look at them and go, no, you have to figure it out. They're like, what are you talking about? They're like, well, you either give us more cash or we're going to default on all your debt and you're going to have to mark it all at zero. And they'd go, all right, well, let us go round you up some more money for debt. Right. So they were literally raising private equity debt to bail out private equity debt. So
I heard Credit Suisse got involved in a lot. The Credit Suisse had tens of billions of loans out to like family offices, hedge funds for bad trades, and also private equity. Credit Suisse was heavily involved in that stuff.
Yeah. And that's the other thing. When we're sitting there talking about a recessionary call this year, look, I'm never going to discount ever again in my life. I will never discount the power of unlimited printed money. Okay. But when you look at what this economy is up against in terms of virtually all of now big tech is still motoring along pretty well considering the conditions. But outside of that, every engine, every driver of this economy for the last 15 years has hit a brick wall. Right? Private equity. And the crazy thing, Jason, is listening to the lack of reporting on it, right? Nobody's even saying a word. They're acting as if everything is normal. Private equity is in a squeeze right now. I mean, it is brutal. I sit on a board for a private company, and one of my other fellow board members is a senior partner at a fairly sizable private equity company, private equity firm. And he was just telling me, he's like, Zach, it's a mess. We're going to take like everybody. He's like pretty much. Is it
up there with like commercial real estate losses like that bad?
Yes. Now I think it's not as consistent, right? Meaning if your commercial office space, all of you have the same problem to some degree, right? Like you're all fighting the same war. There are obviously still some great assets in private markets and private equity markets. But the issue, look, this is kind of like the diagnosis. Again, I know I'm not telling you anything you don't know. But if you want to find a bubble and if you want to know where there's a bunch of hidden landmines, go look at the industries that have had the biggest inflows of cash in the shortest period of time. Private equity, you know what I'm saying? Like anytime a form of investing becomes so popular that you see the inflows going into it, all of a sudden, for whatever reason, you see the inflows going in 5, 6x, 7x, ratcheting up to records, setting new records. You know for a fact there's a bunch of trash in there. Why? Because Wall Street is never going to tell you we don't have anywhere productive to put that money, right? They're going to take it every time. And what are they going to do? They're going to keep funding incrementally worse and more risky corporations. They're going to keep doing more and more weird, nonsensical things. Why? Because they want the funds.
Yeah,
right?
Especially with pension fund money. Look at the shale oil bubble. It went into worse and worse investments there that went bankrupt. There was tons of shale oil bankruptcies. I think in the 2015, 2016, there was a huge bear market, tons of bankruptcies. So Wall Street's not just going to hold the cash. They're going to put it into something. They give it to private equity a lot too. Although now they're probably not, but they were over the years, the last 15 years.
So here's I'll throw this question at you, and this is something I've been wrestling with. What do you think's more likely over the next 2 years? And to be fair, I'm just throwing this question out there. I don't really have an answer. I have what I think, but I don't, obviously I don't know. What do you think is the most probable outcome? Do you think we're heading for a blow up, or do you think we're headed for, in one way, shape, or form, even higher rates of sustained inflation? Because here's the one thing, looking at it through the lens of financial history, we'd sit there and be like, oh man, and I'm sympathetic for the guys that are sitting there going, this thing's about ready to come apart. If you look at financial history, absolutely, right? If this was like it was back in the 60s or the 50s or something like that, these conditions would result in a 60 to maybe even 70% market drop, right? And devastation. But here's the thing. You and I both know that those in power have no interest in that happening, and they're not going to allow it. And they can just print over the top of it. Now, and that's why I think this year is such a fascinating setup, because the only thing that saves this from hitting the wall that is recession, and if not bad recession, is the printing press. That's it.
Well, rate cuts too. I've heard Wall Street, current and former bankers on Wall Street and hedge fund people that are retired just say, like, basically some of these companies, if the Fed doesn't start to cut rates in the next, 6 to 12 months, and these companies don't start refinancing, like, the shit's going to hit the fan.
I know, but check it out. So let's go do the math. Now, will that help the equity markets? I'm sure, because like I've said, this is the most price agnostic and risk dumb market I've ever seen in my career. And that's not even, I'll even take it a step further. It's the most risk dumb market that's ever existed. Okay. So if even if they raise, let's say the market's right. Fed says we're going to get 3 rate cuts. Market's pricing in 6 quarter basis point cuts. What does a Fed funds rate 1.25 points lower than this do? What does it do? Economically, it does nothing. People go, what do you mean, Zach? And I go, look, the average effective mortgage rate in our country right now is 3.9%. So if we add up all the mortgages together, what is the average person paying? 3.9. Okay, so that means to move the needle on the rate side, to get it back to the place where people are actually, doing refis, things like that, accessing credit, that means that you need to get 30-year paper below 3.9. Where does it?
You also don't have a lot of people who want to sell, who want to cash out of that cheap mortgage and go and get a higher mortgage, because then they mean a much lower house. So they don't want to do that at current level.
They can't afford it. Right? Like, yeah, it's not even they don't want it, they can't afford it.
Well, they could trade down, they could downsize enormously square footage to, like, say, from a sizable single family home to like a 1 or 2 bedroom condo or something. But yeah, they're going to be paying through the nose on mortgage costs.
Yeah, but who wants to go from paying a $3,000? Like, look, I'll just tell you, look at my scenario, for instance. Okay, I've got a 3,000 square foot house in a nice neighborhood on a half of an acre, okay? And I've got my mortgage at 2.75%. So I think my house is valued at like 1.2 million or something like that. And on that home, I have a $3,100 mortgage. Okay, 30. Like, am I going to go out and flip houses and upscale? I got 3 kids now, so we've got 4 bedrooms. I can use a little more space. Am I going to upsell right now and go get a $1.5 million house? Just a 300.
No, not when your mortgage is like 6,000 a month or almost seven. I mean,
Yeah,
the mortgages
75.
are like
Yeah, 70. Yeah, $7,000 a month. Yeah, that's insane, right? For an extra 500 square feet or something like that. So I think what I think is just, and I think it's just a fascinating thought experiment is to look at this next year and see how it unfolds. Because even if they lower rates, even if they get those 6 rate cuts that the market's factoring in, because remember, the Fed funds rate is the foundation, right? So wherever the Fed funds rate is, on average, mortgage rates are going to be, probably I'd say on average somewhere between 150 to 250 bips above that, right? Maybe that's not the exact number, but it's probably right in that ballpark. So everybody's looking at the Fed funds rate, but you're like, nobody pays the Fed funds rate, right? It's a multiple on top of that.
Well,
so
almost everything's priced off the 10-year U.S. Treasury, which is, again,
right.
why I think Janet Yellen panicked and went in there, because she was starting to realize that, like, had rates stayed at 5 or gone higher, that, like, everything else was going to start to price a lot off those higher 10-year U.S. Treasury yields.
Well, here's another interesting thing that you bring up. Now, this is totally speculation on my part, okay? Because 5 is a round number. There's significance there. It's half of 10. I get all that. But you and I have both watched markets for a long time. Do you ever see something hit a round number like that and stop dead?
Paper gold price manipulation. Yeah.
No. But my point, therein lies my point, right? That is not typically the way markets work, right? They don't hit round clean numbers and then just reverse right off of that. Maybe they did. I've got no way of proving that's not the case. I'm just saying you put it in with all the other stuff. And my biggest thing is this. I just don't think people realize, especially the average person out there, and rightfully so, because the average person shouldn't have to worry about this kind of stuff. But looking at this setup, looking at this next year, I think one of the most fascinating things that we will see, at least in my opinion, is what happens this year. If we don't go into recession this year, and I've had this conversation with our clients, and I've had this conversation with our analysts, and I've sat there and I've said, guys, I'm dead serious. If we don't go into recession this year, we have to permanently alter the way until there's reason to go back. We're going to have to permanently alter the way that we manage money, because what it will mean is that there are absolutely no constraints. I just don't think people realize the pressures that are built up in this economy. And like I said to you, on a historically normal, I hate using that word because what does it mean? But on a historical basis, if you don't go into recession, it's going to be one of the most incredible things I've ever seen. And the only way you get there is through printing, whether it's through back channels like you brought up, which I couldn't agree with more. And I think it's impossible to deny that's happening. But just the pressures. You've already got an unemployment bouncing. It's not going high, but you've already hit some of those magic numbers that once unemployment has bounced, what is it?
Well, the jobs reports are fake too, man. I mean, like a month later, they're revised downwards by 50%. The largest source of job growth the last 12 months are government jobs. The jobs report data is saying that a lot of people have 2 or 3 part-time jobs. There's a lot of red flags there.
No, the job reports they're complete nonsense. That's the other thing. Have you ever noticed that the market moves on the headline number, but never the revision? Right?
Oh, yeah, I notice this all the time. Yeah, I interviewed John Williams at Shadow Stats, and we went through the jobs numbers. Yeah, the jobs numbers themselves, like it's all to fool the algorithms so the stock market doesn't crash and it rallies. And then they smash the gold price too normally.
Yeah, and then they release it 2 or 3 months later, right? The reality.
Okay, Zach, as we wrap up here, I want to just get your thoughts, since you were saying that like so much of the market, the valuations are distorted, risk on, risk off, it's bipolar. I know that you do look for undervalued commodities producers. Well, not just commodities, but any sector in general. Risk reward, undervalued cash flow multiples, or free cash flow. Are you looking at some of these Canadian and U.S. oil producers or some of these gold stocks? Because I'm running the valuation metrics myself, and the risk reward valuation metrics, it just looks really, really cheap for some of these producers.
Yes, it does, and we are. And let me offer a little bit of a warning or caution statement before I say this. Look, just because something is cheap doesn't mean it's going to work immediately, right? But at the end of the day, if you want to know how to navigate these times financially speaking, it's not easy. But you have to do what everybody else is not willing to do, which is you stare solidly at the fundamentals. At the end of the day, guys, investing by definition is buying discounted cash flows. That's what it is. And at the end of the day, buying discounted cash flows is how you make the most money. And it reminds me very much of conversations that I had with our clients when oil went negative. And it's fun to talk about now because we all saw what happened to energy prices and oil stocks and all that kind of stuff. But at the time, I'm just telling you, I didn't go into this as heavy as I should have because of the risks involved. But we started buying oil stocks right around the time that oil went negative 38. And I got panic calls from clients. Go, Zach, what do we, and why are you, haven't you seen what's happened? Oil's negative. Why are you buying oil stocks? And I said, well, guys, they're giving it away. So this may not be the bottom, but we got to be close, right? So,
well, aren't we? We're back to. I know there's been a little bit of short covering by hedge funds in the last couple days this week, but we were up to actually worse than for oil futures contracts that were net short by hedge funds. We were at 2020 pandemic levels in the last couple of weeks.
Yeah, which was stupefying for me to see because you made a comment. I truly believe, now I could be proven wrong. We might be slightly off. I don't think we're off by much, but I think that and oil and all commodities have a history of doing this, so it really makes sense. I think $65 to $75 oil is what $35 oil was 15 years ago, meaning that, and I think it's actually even more acute than that because of the production issues that you've talked about, right? When you look at the capex that has gone into in all commodities, not just oil, when you look at the capex that has gone into any and all commodities over the last 10, 12 years, it's actually negative. Like when you factor in the bankruptcy company, the bankruptcies and all these other kind of things. So there's been no new net investment in any of these spaces for an extraordinarily long period of time. And so will it work immediately? I don't know, probably not. But there's a couple things I think people are missing. It's the old adage, hard times make good people, hard times make good men make good times. The time in the commodity, you brought up gold miners. This is specifically true. It has been like a nuclear winter for these companies. And I got very disillusioned and very frustrated with the energy, or excuse me, the gold mining industry as a whole, just because they wasted so much capital and they did so many stupid things that are really well documented. So much of that stuff has been beaten out of them. And I would just to point out an example, I would tell you just to go look at Barrick Gold. That is not a company we own. I think there's way more frothy plays to pick up in the gold space. But go look at Barrick Gold and all of its financial performance metrics and compare it to where it was 12 years ago. What you'll see is a transformed company. Okay, and then the same is true in the E&P space on the oil and nat gas side. And it's something that I don't think people are adjusting to. And I think it's one of the biggest things that you see in this market writ large. For instance, look at this market this year. You know what this market's trading like? It's trading like rates are still at zero, even though they're not, right? What is E&P? What is the energy sector trading at? It's trading like it's 2019. It's not. What's the biggest difference? People aren't understanding, especially in the energy space, that what has happened over the last 2.5 years has been a transformative change for these companies. meaning a lot of these companies have completely paid off the debt, right? They've been drowning on debt for the better part of 15 to 20 years. It's actually been a feature of commodity companies, right? Well, you've had no new capital flowing into the space. So these guys have had to really rediscover religion as it relates to cost cutting, as it relates to efficiency, as it relates to anything. And what I'm telling you is, I'm not telling you I know the timing. Nobody does. And if they tell you they do, they're full of it. And that's the one guy you shouldn't listen to. But what do you look for? You go look for ridiculously low priced equities and ridiculously low priced ventures in comparison to the rest of the market. And then, like I said, what makes this so much easier is a lot of these things have just whistle clean balance sheets. We're no real, I think a couple of the energy companies we own, Jason, and we're getting 5% dividends from them, 6%, 7% in some cases. We're getting special dividends, monster. We got a special dividend from one of our energy companies this year, whose stock is negative on the year, by the way. It's negative on the year, and they gave us a 17% special dividend in Q2, right? So what people need to understand is that buying the best investments, it never feels good, right? But at the end of the day, quit thinking about them like a stock and look at the cash flow. And I bring this story up about what we did a few years ago because I had several talks. I've got some really smart clients. And what they said to me, they go, Zach, what if this is so screwed up that cash flows don't matter? And it's when a bell went off in my head. I haven't heard that many times, but I've probably heard it 4 or 5 times over my career.
Well, they matter eventually. They matter eventually,
right.
Unless you can do WeWork capital raises.
Yeah, right. Which nobody's doing that for an E&P energy company or a gold miner. But yeah, no, and they do matter eventually. But what you start seeing, and I feel like one of the moments I look for is where, because beat down sectors are almost always beat down for a reason, right? It's not just because whatever. You look at the way the energy sector is a perfect example. Go look at the way the energy sector operated from 2010 to 2014. It shouldn't really be a surprise, right? It was ridiculous. I mean, those guys were as bad at asset. They literally were as bad at allocating capital as the government is. It was ridiculous. Okay, well, those companies are gone. They're gone. Only the strong survive, right? And the strong that have survived have taken it on steroids, right? Meaning we're looking at a lot of these companies. That one I was telling you that issued that dividend, they've battled with debt for 15 years. They're now debt free. They don't have a dime of debt on their balance sheet, and yet.
So the market is still punishing them, even though the fundamentals of the company are superb now. Yeah, you see, we're going to see this with the gold company. If gold prices stay above 2,000, I mean, some of these companies, the royalty and streaming companies, they're going to mint money. The gold miners that have low costs that are under like 1,400, they're going to mint money. So the next couple of quarters are going to be good. The stock prices are not reflecting those good cash flows and earnings at all.
No, Jason, they're going to mint money. And here's the other thing you look for too. Right. The other thing you look for, again, in my experience, and I think history backs this up as well. The other thing you look for is you start calculating, what is my worst case scenario? Okay, let me just tell you something. If you don't like gold stocks here, it's because you think that gold doesn't matter anymore. And why do I say that? I say that because you get below $1,600 gold, and almost that entire industry is substantially cash flow negative, right? I don't think I've ever seen gold have that low of a floor on it. Meaning, well, I think gold's going back to 1,000. I'm like, no, it's not. They're like, how do you know that? And I'm like, because if it does, there won't be any. Right?
It's ore grades, it's energy costs, it's ore grades, it's labor costs, capital costs, all these costs over the last 5 or 10 years. And I've been covering these gold stocks since like 2008. The costs are up enormously.
Yep. And here's the thing. And this is where I think investors are holding up. You see the same dynamic playing out in energy markets. One of the reasons that energy stocks still are not valued fairly is everybody is still playing off of, they're going to overproduce. These guys always do that. And I go, no, guys, the reason they overproduced is because of the debt load. Anybody that's ever managed the balance sheet of a company knows, even when you're losing money, right? cash flow is important, even if it's negative. It's like water going through the gills of a shark. You got to keep moving when you're loaded down with that much debt. They don't have that constraint anymore. So they don't have to keep printing. So if the price of the energy drops, there will be substantively less. Gold is in exactly the same scenario where people, oh, gold's going back to 1,000. Okay, so what you mean is that nobody's going to want gold, that gold demand is going to be zero. They're like, that's not what I said. That's ridiculous. And I go, yeah, it's not what you said, but it's what you said, right? Because you don't understand the economics. You think companies are out there like excited to go sell gold at a 40% discount to cost? So these are
There's
the
like
things
almost zero, other than a handful of gold miners. There's no gold miners. Maybe Lundin Gold. There's a few others, maybe a couple in Africa that can produce at those levels. Almost no one can.
Yeah, no, yeah, and then you drill down a little bit deeper and you go, there are some that can, but it's a minuscule percentage when you compare it to demand, right? Like it's kind of a red herring. Like you can sit there and be like, well, somebody could, yeah, but not anywhere close to the amount of demand. So if you want to look at me as a serious human being and tell me that there's no more use for gold, nobody cares about it anymore, I'm going to laugh at you, but that is a more sound argument than arguing that natural market forces are taking gold back to $1,900, right? Like, because you're looking at it going, the only way it gets there is if there's zero demand. And I think the same is true in energy markets. One of the things that's priced into energy market stocks right now, and I'm just telling you it's priced in, and you can hear people that don't want to buy it, you can hear them say this, they just keep pumping money back into the ground. You never get your money back. And I'm like, yes, that's what they did. Why did they do that? Because they had to have cash flow to service their debt. Those companies are gone. The only ones left are the ones that have, very strong, if not fortress balance sheets. So my point is, when you make your best investments, it's never going to feel good. Right. It's just
look at uranium a couple of years ago. I mean, now uranium stocks are soaring. Everyone hated them. Every time they rallied, I was getting messages, sell uranium. It'll never rally. It's been in a bear market for 12 years or 15 years. And now we're in a uranium nuclear power bull market.
I'm glad you brought that up. Classic example. And guys, we could do a show where I talk about the things I've gotten wrong, because I've gotten plenty wrong. But here's an example to what you just said. I remember buying our first entry into uranium we bought is probably 2 or 3 years ago. I can't remember exactly what the day was, but all I know is I remember we bought Cameco right around $8. And a lot of these same dynamics that we're talking about with energy and gold were true. What did Cameco close at today? 43, 44, something like that.
It got up to 50. There's been some profit. The hedge funds are piling in. All the generalist investors are adding it as window dressing. I mean, it'll have a pullback. I think there's a long-term bull market, but it's frothy right now.
Yeah, it is. It is. No, I'm not saying it's not at all. And as a matter of fact, we actually did we sell? We cut our position in Cameco in the last month by probably half, I want to say. I'd have to go back and look at the trade sheet, but I think we cut it in half for those same reasons. But what I'm saying is, what is that? It's an 8x or no.
Five bagger.
5-6 bagger, right? In a relatively short period of time, 3 years. You got to go into those places, and the way you find them is not complicated. The way you find them is when you're sitting there going, holy smokes, I'm getting 20 or 25 for it wasn't this case with Cameco, but Cameco was a little bit differently because they weren't cash flowing like the energy companies to me right now are one of the biggest slam dunks in investment history, meaning the balance sheets are cleaner than they've ever been in 25 to 30 years. A lot of these things are trading at sub 8 times earnings. A lot of these things are throwing off cash flows that are 15, 20, 25% of market cap. Maybe it's a little bit overstated saying a lot of them are, but they're out there. And then you look at that, they're garbage business. And I go, guys, the earnings yield on Microsoft is 1.9. Okay. If I'm going to get a 15% earnings yield compared to 1.9, I'm okay if people think it's a garbage business. Why? Because my margin of safety is pretty dang good, right? It's an 8x margin of safety in terms of earnings yield as opposed to these tech companies. So you're buying cash flows. They are horrible. But you and I both know valuation is a horrible timing indicator. And I'm not saying because that exists today that they're going to be the best performing stocks next year. What I am saying is that there will be something that occurs that makes them more valued. And it could be as simple as a stock market drop in a recession, meaning people will realize this is vaporware. And we have a saying at Bulwark where we say, at the top of cycles, everybody is a technical analyst. At the bottom of cycles, everybody's a value investor, right? Why? Because at the top of cycles, the trend's always gone up. The trend's your friend, ride the trend. At the bottom, everybody that did that got blown up. And now they want to look under the hood and make sure they're buying a fundamentally sound vehicle. So it like everything else in life, it takes discipline over the short term, but this is just math. If you want better performing assets, these things, in my opinion, are still generational buys. And if you've never been through, you bring up gold specifically, we are so overdue. If you are impressed by tech and crypto, wait till you get into mid and small cap solid gold mining companies in a proper bull market. Okay. Like I've always joked around, wait till the bull market in gold equities gets rolling, and wait till the guys at Wall Street Bets find that, right? Just because you and I both know, I mean, it is incredibly powerful. And when do all of these bull markets start? They start when the equities have been absolutely left for dead. And when you're sitting there right now looking at gold trading above 2050 and GDX below 32, if you told me those things were going to happen 5 years ago, I would have laughed in your face. There's no way.
There's also no capital. I know your parents worked in the gold mining industry. There's also no capital available for these junior explorers. I mean, some of them are trying to sell out for pennies on the dollar, trying to sell. They're on the phone, making emails, trying to sell the company to larger miners right now.
Yep. Yeah. You could almost say that there's negative investment capital for those companies. Nobody's putting money into those things. So no, I agree with you. And look, it's like I said, not looking for short-term results. But you don't even need to get on the conspiratorial hyperinflation bus to be a fan of these equities. Just go do a basic fundamental analysis of these things and look at the cash flows. And they're incredibly stupid and they're ridiculous. And then you look at all of these nonsensical companies. I was looking at a quote unquote AI research company the other day that has 9 million in revenue and a $3 billion market cap. Hey, maybe it ends up being a great trade. I don't know. But then you're sitting there showing me these companies that are trading at 3 times earnings with 20% free market or free cash flow to market cap with zero debt on the balance sheet. I'm taking that all day long.
Yeah, the mid-tier royalty companies, let me add here as we wrap up. So the mid-tier royalty companies on a valuation with cash flow multiples, their free cash flow relative to metal prices. So like a Cisco Gold Royalty, Triple Flag, Sandstorm Gold, this is the cheapest they've ever been. So going back data over 10 years, these mid-tier royalty companies, and these companies don't have to worry about mining. They just generate tons of free cash flow. I mean, Franco-Nevada has the one problem with the major asset. I think Franco-Nevada is a good turnaround play at these levels.
Well, and the other key thing too, and I actually think that the streamers might be the absolute best way to play what I believe is a coming gold market, because why? Most of them, depending on how those deals have been negotiated, most of them are not exposed to higher costs, right? They get paid their royalty in gold ounces, right? So their
margins can't be destroyed. Yeah.
Right. So even if the cost on the miner that they've got the deal with goes up 40%, theirs doesn't, because they're owed gold ounces. So it literally is just, that's another funny thing. You watch the gold streamers get priced like gold miners. They're not. They don't have mining risk. There is some geopolitical risk because the mine can get seized.
Well, yeah, look at Franco. Yeah.
What it tells you, though, is it tells you it is a space that no one's in, right? Because a good gold streamer should always trade at a solid premium above a miner, all things being held equal. Or excuse me, a gold miner, not a miner in terms of their size, but somebody's actually putting shovels in the ground. Why? Because they don't have any of the risk exposure or the margin exposure or all the stuff that you mentioned. So when you see these dynamics, look, I'll tell you right now, I firmly believe that unbelievable amounts of wealth are going to be generated in the commodity space over the next decade. And I think the setup is perfect when you look at a sector that has had no real investment, no real capital inflow for the better part of a decade, that is priced this cheap. And then usually when you get into these value plays, you've got to buy bad balance sheets. That's the other kicker is these guys, most of these things you can, well, I'm sure there's some that are exceptions, but you can find beautiful balance sheets. That's the anomalous part of this is that they're still being traded like this wart covered stepsister, and they're not that at all. They're really not. So look, I think the
it doesn't make much sense. I think what you just pointed out in a bunch of details, not much sense right now.
No, it doesn't make much sense. And so what you do in these environments is you sit down with your clients or you sit down and have this talk with yourself and you go, look, I have no idea what's happening in the short term, guys. All I know is this. If somebody wants to sell me $1 for a quarter, I'm going to do it until they're out of dollars, right? I'm just going to do it till they're out of dollars. And I think that's the setup we're looking at in the vast majority of the commodity space.
Yeah, I think the earnings, especially for a lot of these gold miners and the royalty and streaming companies, other than maybe Franco, but I think Franco will fix the things over the next 6 to 8 months for sure. They'll do another deal or they'll negotiate some type of settlement. I think the earnings for the next couple of quarters for the gold companies are going to be very, very good at these gold prices, especially with lower energy prices.
Oh yeah, I mean you've got Nirvana right now. I mean oil can go up and bust that at some point, but I also, I've been watching gold. And who knows, we could have a conversation a month from now and I could be laughably wrong. It feels like a loaded spring, man. And look, I'm not loaded up in these companies either. I'm not you know me, you and I have talked long enough. I am not one of these always gold guys. I'm not. I've been around the industry my whole life. I think there are times to be in that sector heavy, and I think there's times to get out. But now is again, I
the risk reward and the valuations with the balance sheet and the cash flows. You're seeing that the risk reward is very, very good. Then
it's what you're looking for. It's how every single gold. I spent summers of my life as a child at gold mining operations. I've been around this industry my entire life. What I am telling you is what is happening right now has marked the beginning of every single gold bull run that I have seen in my lifetime, and you haven't had one. The last one ended in 2011. So you haven't had it now for 13 years. People have forgotten. And I think the one that happened from 08 to 11 was it actually happened from like late 90s to 11, but it was really quiet because of what happened in the housing market. It never really got a lot of press. But I think the one that you're sitting on now, when you look at balance sheets, when you look at how barren the industry is, when you look at the fact that no new net gold mines have been opened in the last 12 years, when you look at all these different factors, then you look at valuations and cash flows, you're just like, hey, like I said, when is the market going to realize it's $1? I don't know, but you're buying $1 for a quarter.
I think in the coming quarters, if their earnings and the free cash flow are good, the market's going to eventually figure it out. So it won't happen right away. It might take a couple quarters of really good earnings and cash flows.
Yeah, and if it's like other ones in the past, it'll happen really fast, right? So
look at uranium, how quickly that happened. Yeah.
Yeah. Oh, yeah. Us uranium fans were sitting on that, being told we were idiots for a couple of years, and it's just always the way these things happen. They're not progressive. They don't happen the way other things do, right? Like it's just the way markets work. Sentiment gets way too negative, and it doesn't matter what good news comes out; nobody's buying it. But especially in this environment, and that's why I think the soil is so fertile for this, because you look at anybody's portfolio, you and I, somebody needs to show me their portfolio. I know what it is. Let me guess. Tesla, Apple, NVIDIA, Netscape, or Cloudflare, Snowflake. It's all the same. And it's never been as much as it is now.